Hello, I'm John Summers from FMA, and I'm here to offer some information in this presentation on understanding audited financial statements. A nonprofit's financial statements provide lots of very important information about its financial health and performance, but only if you know how to read and understand that information. Of course, many of us in the nonprofit sector, as staff members or board members or even funders, donors, don't necessarily come with a background in accounting or finance. And even those of us who maybe are familiar with financial statements may not be that familiar with nonprofit financial statements, which, as we will see, are significantly different in many ways from for-profit financial reporting. So what I am going to do in this presentation is walk through a set of standard nonprofit financial statements and give some tips about what to look for when we are reading and understanding them. First, just an overview of the financial statements that appear in a nonprofit audit. There are 4 of them. One of them, as we'll talk about, is optional for many organizations. And this is the order of financial statements. First, we have the statement of financial position. This is also known in the for-profit or corporate sector as the balance sheet, and we typically refer to it even in the nonprofit sector as the balance sheet. Next, we have the statement of activities, which is known in the corporate sector as the income statement or the profit and loss, the P&L. Next, we have the statement of functional expenses. This is not known as anything in the corporate sector because there is no equivalent of the statement of functional expenses in a for-profit audit. As you'll see on the screen, this is a required financial statement for what are known as voluntary health and welfare organizations. So not all nonprofits are required to include the statement of functional expenses. It's optional for organizations which are not voluntary health and welfare organizations. We typically think of it as best practice to include it regardless, but the only organizations for whom it is required are voluntary health and welfare organizations. This is a specific type of organization, and if you're not sure about whether you are one or not, check with your auditor. Finally, we have the statement of cash flows, which is known also in the for-profit sector as the statement of cash flows, so we at least have agreement on one of the 4. And then following the financial statements themselves is a set of notes to the financial statements, and we'll talk a little bit about what is included in the notes. So now what I'm going to do is walk through each of these 4 financial statements, beginning with the balance sheet. So the balance sheet consists of 3 components. We have assets, liabilities, and net assets. So our assets are simply what we own as an organization, including cash, receivables, investments, property, equipment. Anything that we own as an organization is an asset on our balance sheet. Liabilities is what we owe to parties outside the organization. So bills due, lines of credit, any debt, mortgages, anything like that is a liability on the balance sheet. And the difference between assets and liabilities are called net assets. That you might think of as our net worth as an organization. If we were looking at our personal, our individual financials, the difference between our assets and liabilities would be our net worth. In the corporate sector, this is called equity or shareholders' equity, the difference between assets and liabilities. In the nonprofit sector, we call it net assets. And as we will see, there are different categories of net assets in the nonprofit sector. Unrestricted, temporarily restricted, and permanently restricted. And we'll talk about the difference in these. So what I'm going to do now is actually move to an example. This is a sample, hypothetical set of nonprofit financial statements for an organization we've made up. And this is what the statement of financial position or the balance sheet looks like for this organization. So we'll walk through it quickly. The first section of the balance sheet is the organization's assets. So this is where we see the assets, and you see the different categories of assets. So we have cash, grants and contracts receivable, accounts receivable. When I'm looking at a nonprofit balance sheet, one of the first places I look at is cash. You might know the expression cash is king, and we have to have cash in order to pay our expenses. So it's important to keep an eye on the organization's cash position and to think about what that cash position is relative to the organization's expenses. The next section of the balance sheet is the liabilities. So liabilities, again, are things that we owe to others. These are our accounts payable, accrued expenses, if we have loans, bank loans, lines of credit, mortgages, all of that will appear in the liabilities section. Now, the difference between assets and liabilities, like I said, are what we call in the nonprofit sector net assets. So this organization has a little over $1 million in assets, $200,000 in liabilities, and so the organization's total net assets, as you will see in the 2015 column, is $821,000. Now, like I said, in the nonprofit sector, and this will be a recurring theme of this presentation, in the nonprofit sector things are a little bit more complicated when we're looking at financials. So although the difference between assets and liabilities is net assets, total net assets, there are a few different flavors of net assets, as we will see in this organization's financials. So net assets in nonprofit financials are broken down into different types, different classifications. We have unrestricted, we have temporarily restricted, and in some cases we also have permanently restricted. That's a little less common for nonprofits. Most have unrestricted and some temporarily restricted. Restricted assets are assets that donors, and only donors can restrict an asset, donors have put some criteria around the future use of that asset. For example, if we have a grant from a foundation for a particular program, that money is restricted until such time as we spend it on the program that we have written the grant for. So a restricted net asset is a contribution that we've been given that a donor has put a particular time or purpose restriction on. Once it's used for that purpose or within that time period, it then becomes unrestricted. Unrestricted net assets are those that we can use at our discretion as board and management of an organization. So a donor has not said you have to use this asset in a particular way. It's up to us how we use the asset. Permanently restricted net assets, and again, this example does not have any, but in some cases, organizations do have permanently restricted net assets. Another term used for permanently restricted net assets is an endowment. Assets that are part of permanently restricted net assets cannot be used at all. That restriction does not expire, it's permanent. So temporarily restricted, when we use for a particular purpose or a particular time, it becomes unrestricted. The restriction on permanently restricted net assets does not expire. The purpose of those is to serve basically as an income generating endowment. So we can invest those assets and use, with particular policies set up around them, use the income that's generated from them, but we cannot tap into the asset itself. So those are the different net asset categories that you'll see on an audit. What we are looking at is our unrestricted net assets, our total unrestricted net assets. So the $244,000 in temporarily restricted are, again, nice to have, but they are basically spoken for. They have to be used in particular ways based on what the donor has restricted those funds for. What we actually have discretion over are our unrestricted net assets. Once again, it gets even a little more complicated, because what we're looking for on our balance sheet is actually our liquid unrestricted net assets. Our total unrestricted net assets include, if we own a building, it will include the value of the building. It will include the value of our equipment, any property that we own. But we can't actually use our building. Our building's nice to have, of course, but if it's time to pay a bill or to make payroll, the value of our building doesn't help us. We can't just easily convert that into cash. So what we pay a lot of attention to on the balance sheet is our liquid unrestricted net asset position. And you'll see on the screen another term that we at FMA use for this is LUNA. This is when we think in terms of our financial reserves. we are really thinking about and talking about our LUNA, our liquid unrestricted net asset number. This is an organization's level of true reserves, the money that it can tap into to pay expenses, to use for working capital, to invest in new programs or opportunities, to weather potential downturns. That does not include the value of fixed assets like our building or our property. If we have positive LUNA, that is our reserve position. That's the assets that we have available to cover operating expenses, provide working capital, and so on. If we have negative LUNA, and that's actually possible, we'll talk about and look at that, that indicates that we have actually borrowed from restricted funds or from external sources in order to pay our expenses. And that shows a lack of financial flexibility. Not many reserves, or really no reserves at all if we have a negative LUNA position. So looking back at the balance sheet, in order to figure out what is our actual reserve position, what is our liquid unrestricted net asset number, we begin with our unrestricted net assets, which again in 2015 is $577,000. But if we look back up the balance sheet at our assets, we will see that included in that is $625,000 in property and equipment. So that's fixed assets. That is illiquid. What that leaves us with is actually a negative number. So in terms of LUNA, we actually have in 2015 a negative $48,000 liquid unrestricted net asset position. Now you'll see in this balance sheet it's actually broken out separately. That's not always the case, and I would suggest on your balance sheet you might talk with your auditor and actually present on your balance sheet your operating net asset number, as it's called here, or your liquid unrestricted net asset number, because that gives us a real indicator of our financial health, our financial flexibility, what is our reserve position. And as you'll see in this case, when we subtract out the value of our fixed assets from our total unrestricted net assets, we'll see that we've actually dipped into the negative, which means that we have drawn from, in this case, probably temporarily restricted net assets in order to finance our operations. That can be a challenging place to be financially. Okay, the next statement that we are going to talk about is the statement of activities, the P&L or the income statement. The balance sheet that we just looked at is as of one particular point in time. So if I go back to the previous slide, we'll see that this is as of June 30th, 2015. This is what our assets and our liabilities and our net assets looked like as of June 30th, 2015. The statement of activities shows us our financial performance over the course of a period of time. In audited financial statements, it's over the course of one fiscal year. And it tells us over the course of that fiscal year what our revenues looked like by type and by restriction, what our expenses looked like broken out functionally, we'll talk about what that means, and what our operating results were, what was our gain or loss, our profit or loss for the year. So now we will go through a statement of activities, an income statement for this same hypothetical organization. And you'll see there are a few different columns on the statement of activities. We have our unrestricted column. This shows us our revenues that came in on an unrestricted basis for 2015. So again, that's revenue that we could use to fund operations in 2015. And it also shows our expenses for 2015. And you'll see that the expenses are broken out into program services, management in general, and development. So it is required, one of the requirements of financial statement presentation is that our expenses be broken out into these three categories on the statement of activities. So if you have heard of things like ratio analysis or efficiency ratios, things like that, that has to do with the percentage of your spending that goes to these different categories. So your program percentage, your management and general percentage, your development percentage, and that's shown here. And you'll note all expenses appear in the unrestricted column. The next column on the statement of activities is the temporarily restricted. That shows us revenue that we generated in 2015 but it's restricted revenue, so it could not actually be used to fund our expenses in 2015. It's restricted for future use. It might be restricted for a particular time period. It might be a multi-year grant that some of the funds are restricted for future years. It might be a grant related to a program, but we haven't executed or we haven't completed the program yet, and so those funds have not yet been released. So the temporarily restricted column shows us revenues that were raised or released that year on a restricted basis. What I mean by released is, and you'll notice in the temporarily restricted column, there are no expenses. There's no such thing as a temporarily restricted expense. If you see that on your audit, probably something is wrong. Deductions from the temporarily restricted column come in the form of releases. So you'll notice $272,000 was released from temporarily restricted and moved into unrestricted. So this net assets released from restrictions line will always balance, will always total to zero, because once we use our temporarily restricted assets for the purpose that they were designated, then we can move that asset from temporarily restricted into the unrestricted column. So that's what's going on in this line. So we have our unrestricted column that shows us revenue that was generated on an unrestricted basis and expenses. We have our temporarily restricted column, which shows us revenue that was generated on a restricted basis as well as released to unrestricted. And then we have our total column, which I like to joke was put there to confuse us. Now, it wasn't literally put there to confuse us, but basically what the total column does is total, obviously, so that we can see overall change in net assets. But the challenging thing that it does is it actually combines unrestricted revenue with restricted revenue. So again, unrestricted revenue is revenue that was available for our use during the fiscal year. Temporarily restricted, we raised, but it's not yet available for our use because it is still designated for some future purpose or a future time period. So the total column brings those two things together. But when we're actually looking at financial statements to understand what happened, the unrestricted column is where we want to look. That's where the action is. If we want to look at one place in particular, and probably the most important number on the statement of activities is the change in net assets in the unrestricted column. Change in net assets on an unrestricted basis is our true operating results for the year. That's our bottom line, even though, as you will notice, it does not appear on the bottom line in the statement of activities. That is still our operating result for the year. So you'll notice in this case that for 2015, our operating result was a deficit of $111,000. Now again, I just want to contrast that with if we look at our change in net assets, or our bottom line, quote bottom line, in total, it looks like an $11,000 surplus, but that's not the reality of what our operating result was for the year. So that's why looking in the total column can be a bit confusing. Let's kick that out. What we want to pay attention to is our change in net assets in the unrestricted column. That shows us the operating deficit that this organization ran for 2015. The next financial statement that we're going to talk about is the statement of functional expenses. Like I said, this is not a statement with an equivalent in a set of corporate financial statements. And it's not necessarily required for every nonprofit organization, only what are known as voluntary health and welfare organizations. But we often see it in nonprofit financial statement audits, and it's generally thought of as good practice to include it as well. It shows us how we utilized our resources over the course of the year in specific functional expense areas as well as natural expense areas. So the statement is set up as a matrix. It categorizes our expenses as programmatic, management, administrative, or development fundraising related. And it often breaks down programmatic expenses by individual programs. So we have to show program, administrative, and fundraising breakdown of expenses on the statement of activities. What the statement of functional expenses does is breaks that down even further. So we will take a look, apologize for all of the small numbers here. we will take a look at an example of a statement of functional expenses. So you'll see that the statement of functional expenses has columns for each program, each of the organizations, in this case 3 programs, Program A, Program B, Program C. And we can see from this which is the organization's largest program. Program A has a total expense for the year of $823,000. Program B is $425,000, and Program C is the smallest at $170,000. We also see how much the organization has spent in management in general, as well as fundraising, and then in total. We also see natural expense categories. So those are the lines. We've looked at the columns that show the functional expenses. The lines show each of the different natural expense areas. So salaries, benefits, taxes, fees, occupancy, all of the different costs associated with running the organization. So you can quickly use this financial statement to do some expense analysis, to understand what are the biggest drivers of expense for the organization. Of course, in almost all cases, the biggest driver of expense is personnel related for our nonprofit organizations. So we can see what the total personnel costs associated with this year's operations were. And then what I typically do with the statement of functional expenses is just scan it to try to understand the other primary cost drivers for the organization. So in this case, professional fees, supplies, depreciation expense is significant. You will also notice lines like telephone, for example. Now, we have a total expense there of $32,000, and that is spread across the different programs and functions of the organization. What that means, obviously, each program doesn't have its own telephone bill. That's typically not how things work. What's happening there is costs are being allocated across functions. The organization comes up with an allocation strategy, an allocation methodology to share expenses like telephone and depreciation and insurance and interest across the different programs and functions that benefit from those items. Another thing to keep in mind about the statement of functional expenses is that your organization should actually be budgeting on this basis as well. So you want to think about your budget in terms of both natural expenses and functional expenses. And there is a tool on strongnonprofits.org, the website where this presentation is being hosted. It's called the Program-Based Budget Builder, and it will help you budget your organization's expenses on a functional basis. And the way it looks is very similar to a statement of functional expenses. The final financial statement that we will be looking at is the statement of cash flows. Now, the first thing to note is that the statement of cash flows is not the same thing as a cash flow projection. The statement of cash flows actually looks back at the previous year and shows where our cash came from and how it was used. It's not the same as a cash flow projection, which is actually a forward-looking financial document, which projects cash coming in and cash going out over the course of coming months and weeks. The cash flow projection is a very important tool for effective financial management. The statement of cash flows, again, is a backward-looking statement about what happened over the course of the past period, the past year in this case. Now, to be honest, not a lot of attention gets paid to the cash flow statement in the nonprofit sector, which is mostly okay. We'll take a look at it, walk through it quickly, but it's not something that we generally pay a lot of attention to for a couple of reasons that we'll talk about. It's something that if you're applying for a loan or a line of credit, the statement of cash flows will get some scrutiny from your lender, but we generally don't focus a lot of attention on it in nonprofit financial analysis. So here's what it looks like. It reports on cash coming in and cash going out from your operations. So there's a section of cash flows from operating activities, from investments and investing activities, including investments in fixed assets and capital, and finally from financing activities. So if you have taken out loans or repaid loans, that will be reflected here. If I were looking for one number on the statement of cash flows to pay particular attention to, I would probably look here at the net cash provided by operating activities. So that shows us on a cash basis if our operations generated sufficient cash to fully fund the operations themselves. So we like to see a positive number here. We like to see that we were able to generate enough cash to fund our operations. The caveat here is that the cash flow statement is based on our total change in net assets, not on just our unrestricted number. So when we look at our net cash provided by operating activities, we don't necessarily know that the cash that is generated over the course of the year, the cash provided by operating activities, is unrestricted cash. That's one of the limitations of the cash flow statement for nonprofit organizations. So although we definitely want that number to be a positive number, we can't tell just from the statement of cash flows itself if that number is on an unrestricted basis or not. Finally, at the end of the audit, there are typically several pages of notes containing important information, often referenced in the financial statements themselves. So sometimes you'll see on the balance sheet a value for fixed assets, and it will say, see Note 6, for example. Notes to the financial statement provide lots of important disclosures and clarifications, and they should be reviewed as well for more information about the organization's financial position and financial activities. It includes things like a description of the organization itself, basis of accounting. There is usually information about the different types and values of fixed assets and how much depreciation has accumulated on those assets over the years. If the organization has debt, there's information about the type of debt, the repayment terms. If the organization has temporarily and permanently restricted net assets, there is usually a description of those and a schedule of how much the assets are and what they can be used for. Subsequent events, if anything has actually happened between the end of the fiscal year and the time that the financial statements were issued, which is typically a few months later, there will be a disclosure about if there were some financially significant event that happened in that period. It will be included in a footnote. And finally, any commitments and contingencies. Significant financial concerns that the auditor and the organization feel should be disclosed if there is a significant concentration of the organization's revenue within one source, or concerns about the organization's financial position. Those might be reflected in the notes to the financial statements. So that was a quick tour through nonprofit financial statements, what to look out for, how to read and understand them. I hope it's been useful. If you have any questions or feedback, feel free to reach out to me at the number or address on the screen in front of you. And please take advantage of the other very valuable resources on strongnonprofits.org, a set of tools and resources developed by the Wallace Foundation and FMA. Again, I'm John Summers from FMA, and I appreciate your time.